Welcome to the Funds Ireland MiniCon podcast. Mini conferences, mini conversations with and for the funds industry. We're looking at ways to transform challenge into best practice, and we're doing that in the areas of people and culture, technology, and innovation.
Hello, podcast listeners, and welcome to the FIMC podcast with me, Danny Lawler from Quest. If you're new to the FIMC podcast, do hit the subscribe button on your preferred podcast provider. And if you like the episode, please be sure to hit the like button. It's going to make you feel better. It's going to make me feel better. It's going to make you a better person. So why not do it? Do the right thing. Hit the like button. My usual co-host for these FIMC podcasts is Shannon Eastman from Teach a Brand to Fish. Now, unfortunately, Shannon can't be with us this time. She is absent with leave, but I suspect that this episode has too many lawyers for her, because not only am I here, but our guest for this episode is Andrew Tzialli from Philip Lee. Now, Andrew is one of my favorite people, and he's also a lawyer, by God, but he's a good guy. And over the last 18 months to 2 years, we have worked together with a number of firms who have been interested in becoming regulated. But as we have explained to them the process involved and the cost involved and the number of rules involved, we can feel the other end of the line going quieter and quieter. And we can feel the shoulders slump as they slide off the chair and under the desk, and the reality of being a regulated firm and all that goes with it, which I'm afraid is quite costly. Starts to sink in. So we thought, what would be more fun than to bring that conversation to life on a podcast, and that you all share in the joy of understanding the burdens of being a regulated firm and the costs associated with it. So Andrew is my guest. We're going to chat through, exactly as I mentioned, that kind of conversation we have with firms where they usually are in crypto or some sort of disruptor tech kind of sector, or maybe it's electronic money or crowdfunding, those kind of sectors. They're interested in becoming authorized. And as I said, we now play out what that looks like, what the costs associated with it are, and what the benefits are once you get through the other side. By God, there are some, thankfully. Okay, with that, let's get on with the podcast. Hello, Andrew. Great to have you back on the podcast.
Great to be here. Thank you, Danny.
How are you keeping? We're in the middle of February. I know you're pining for the homelands of the UK and Cyprus.
I am indeed. But the Emerald Isle is treating us well still at the moment. But yeah, all good. There's a glowing ball in the sky today as well, which is making me infinitely happier. We haven't seen enough of that.
Yes, it does make a difference, doesn't it?
It does indeed. It does indeed.
So we've been having chats several times over the last, I guess, 18 months or 2 years with firms where they have, just to give context for the background to the podcast, Andrew, where they've been interested in getting an authorization from the central bank and being a regulated firm. And those conversations have a bit of a rhythm to them, as we found, and they tend to end up going a certain direction. So I thought it'd be interesting for us to mock that conversation over a podcast, so that everyone can get a sense for, I guess, what is actually required of a regulated financial services firm based here in Ireland.
Yeah. I think certainly the frequency of those conversations and the inquiries we have had from why Ireland, or we're looking at Ireland piece, have certainly increased. It usually begins with, we're currently based in Malta, or currently based in Estonia, or currently based in Gibraltar, or even my motherland, Cyprus. We want maybe a slightly more secure, or slightly, not to take anything away from any of those jurisdictions, but a jurisdiction that is perhaps a little more globally recognized.
Nicely put.
Yes, indeed. I can speak badly about Cyprus, but I won't say anything else about any other places. A slightly more solidified and long-standing regulator in place, and they want to be seen as legitimate. It's not to say that any of the companies based in those countries, of course, aren't, but there is still, on occasion, a perception that they may not be. Are they just there because it's easier to get regulated? So it's almost seen as a bit of a, or starting to be seen as a must-have to be looking at regulation in Ireland or Germany or even Holland. I think, of course, there's still an interest in the UK, but the lack of European presence does change that dynamic. But the real interest is in English-speaking countries with a solid regulatory system, and that's where the conversations usually start.
Yeah, so they tend to be firms. We talk in a second about the kinds of businesses that they're in, and they either are regulated, as you said, in one of these jurisdictions, and are looking to come to Ireland, where I guess there's a perception of, let's say, a higher level of regulation or a greater cachet with being authorized here, plus English speaking and in the EU and all of those things. Or else they come from firms or they're in sectors that aren't regulated yet, and they haven't needed an authorization to date, and they're inquiring about whether there's an authorization in Ireland that they could avail of that would help them to grow and build their business because they'd have that regulatory badge around them. That they're I guess they're kind of the context in which firms approach you and me, begin this conversation about, well, what would it involve and what would it be like and what would it cost to be a regulated firm? Yeah,
exactly that. Yeah, that's it. Spot on.
And the types of businesses that they are, top of my head, crypto seems to be quite frequently somewhere in the conversation. And I guess they tend to be the more innovative type of sector. So it might be an electronic money institution, as it might be a crypto advisor or a crypto exchange, might be something to do with tokenization or anything around that. They tend to be the kinds of firms that we hear from.
Yeah, that's right. I mean, they're certainly the big ones. The tokenization point, and anyone interested in secondary markets for tokenization, digital tokenization of real world assets, or tokenization platforms of some kind. Exchanges is probably the most common one. Businesses that are looking for, like you said, e-money licensing, payment institution type licensing as well.
Crowdfunding, I think, is probably the other one that we get.
Yeah, that's big. Yeah. But yeah, lots of things that certainly sparks the interest of the CBI.
Yes,
to say the least.
And so for those sectors, they're either not regulated at the moment, or there's not necessarily a European regime for them. So, for example, if you were a crypto advisor, generally crypto isn't covered by MiFID because it's not a financial instrument. But if you wanted to advise on crypto derivatives, they are financial instruments, so you'd need a MiFID authorization for that. But it's kind of not necessarily the same approach in all EU member states. But that's changing because we have, we'll talk about it in a moment, the markets and crypto assets draft regulation. There's a draft regulation around crowdfunding as well. So you're going to see a European regime on that. There is one on electronic money institutions. So by hook or by crook, a lot of these sectors that were outside of regulation or where there was no consistent European regulation will find themselves in some form of European regime over the next probably 2 years or 2.5 years.
Yeah, it's unavoidable, isn't it? And as you and I have said when we've had these discussions with companies in the past, look, we may not be able to fit you into a specific category, but this is coming. And if you want to avoid having to completely unpack your business, this is what we think you should be doing. I think you've said before, Danny, act like a regulated business even before you are. It can't go against you. Okay, there's challenges involved in that, but yeah, it's certainly no bad thing if we know regulation is on the horizon for those areas that are not yet regulated, of course.
And so when one of these firms approaches you, Andrew, what are the first question out of their mouth where we're looking for regulation? What's the next question that they have here?
What does it cost? How long does it take? How crypto friendly? A lot of the time, they'll be asking, how crypto friendly are the regulators in Ireland?
Yes.
Maybe I'll let you answer that one, Danny.
Okay. Well, let's start with. Well, I know the first question you mentioned there was cost.
Yeah.
So let's start with that, and it's not so much cost, but let's talk about substance and what needs to be in that business, right? So you will not get a business authorized in Ireland by the central bank, or you could expect the same approach in other member states, unless you can demonstrate to, in Ireland, the central bank and other regulators in other member states, that you are established and present in that jurisdiction. And generally, that will mean we want, as the regulator, we want to see that you have the key people associated with that business located in Ireland. And usually that will mean your chief executive officer, probably your chief operations officer, chief risk officer, somebody around finance, and somebody around compliance. So they're the types of roles that nearly every regulated financial services business will have, and they're the kinds of roles that the regulator will want to see conducted in Ireland. Now, it may be that one individual, because if it's a startup business, one individual could handle more than one of those roles. But I think if you were setting expectations for somebody going to approach the regulator or putting together a kind of a business idea and a business plan, you should expect that you will need at least 3 people full-time located in Ireland in your business, or more, depending on the nature, scale, and complexity of what you're trying to do. So the more complex the activities that you have in mind, the bigger the scale you're planning, etc., the more people you'll be expected to have.
And it's a real presence, isn't it? You know, they want to see it, not just a front. They don't just want to see a shop front. You know, it's a principal place of operations, and like you said, you know, people of repute based on the ground. Yeah,
it has to be credible. It has to be. Now, like, I mean, if you are part of a group, for example, it's quite normal that you would avail of support and leverage off other parts of the business. So, for example, you might have a compliance function, or, well, maybe not compliance, let's say finance and HR function, right? So payroll might get done centrally. Cybersecurity might be managed centrally. Maybe the legal function is central to the group. So you can avail of that and leverage off that, but you need to have in your chosen jurisdiction, in this case Ireland, you need to have boots on the ground that are the people that are running the business and making the decisions and are the mind and management of that. Even in the context of a group, it's not sufficient to have anything approaching a letterbox entity or a brass plate with all of the activities carried out elsewhere. That just isn't going to fly.
Yeah, I mean, you're just not even going to get that off the ground, are you? With that approach, and I think that's one of the things that people are perhaps initially surprised about. You know, they may say, "Look, we've got the funds to do this in our current jurisdiction, and we can invest the time in it, but we don't actually have people that, as yet, that will be on the ground in Ireland day in day out in a fully functioning office." Even on a part-time basis, and that takes time to recruit that kind of caliber, the kind of caliber that we need, particularly for anyone running anything tantamount to an investment fund, a crypto investment fund. That probably needs an even higher caliber, or any kind of payment or banking e-money institution or anything like that.
Yeah, it does take a bit of time, but there's a couple of reasons why a regulator will view a business like that and want to see the right amount of resources in the business in Ireland. One is they have to be able to effectively supervise the business. So if there's nobody present here in Ireland, and if you're a regulator, you're always thinking about risks, you're always worrying about what's going to go wrong. So if something goes wrong with this business and there's nobody in the jurisdiction, who's going to be there to fix the issue and resolve it in the best interests of the investors or the clients of this business? And if there's nobody here, it's very hard to get your arms around the business and effectively supervise it. So that's part of it. But then, and I definitely post-Brexit, you can see this other feature or something that's playing out is around the perception of the European securities and the European financial services industry. You know, if you're going to get access to the European market, then you have to have a presence in Europe. You know, and there's an element of politics around this because, you know, from a prudential perspective, you could run a good business from outside of the EU and sell into the EU and do a good job for investors. But there's another element to this that says, well, actually, if you're going to access European investors, you should have a European presence and contribute to the European tax take and the coffers and all that. It's a kind of different discussion, but it's there in the background. And all of it put together means if you want to have a business regulated by Central Bank in Ireland, you should expect and plan on the basis that you will have a real presence here, and it won't be sufficient to have less than that.
Yeah, and I think when we're talking about cost, it's that really that people are perhaps didn't expect. And I think just maybe related to the cost point as well, is concerns or a lack of understanding around minimum capital requirements as well.
Yeah. Well, they're two big checks you're going to have to write. On the resourcing point, you may find that you could construct a business plan that'll say, well, day one, I'm not going to have any clients, so I'm going to need this amount of people to kind of to get the business up and running, establish, and go win the business. And then once I get clients, I'm going to need on day two this amount of staffing to manage and maintain that business and serve those clients. So you might have a kind of you might have a step approach or day one, day two approach where you're building up your resources as you go. So that's something to bear in mind. You may have resources that, well, in the good old world when you could fly, that come to Ireland to be present, and you find that build up over time as the business builds up. But they are kind of temporary approaches that work whilst the business is finding its feet. They're definitely not something that businesses should plan that they'd be able to do on an ongoing basis or in the longer term. So you're right. When we hit this piece of the conversation, Andrew, that's usually when the line starts to go pretty quiet. When you
as I said,
people as well, so commensurate salaries that they will expect.
Yeah, exactly. Like I said, between that and the minimum capital requirements, they are exactly like you said, Danny. They're going, okay, this is, before we've even started thinking about office space, this is and professional fees. This is looking expensive, or more expensive than we thought it would be.
Yeah.
And of course, even if they go down that road, given the nature of crypto in particular, there's no guarantees, is there? There's still uncertainty around it.
Absolutely. And again, I guess it's getting hotter with everybody seeing what the price of Bitcoin is and people getting excited. But you still have to construct a business model that will, that's credible, but that involves you having enough clients to generate the kind of returns that you're going to need just to keep the lights on, which is the three people who have got to get their salary. Minimum capital you mentioned, so it varies depending on the type of business that you're looking to set up. But if, for example, you were a fund management company, the basic is 125,000 or a quarter of your previous year's expenditure, whichever is bigger, your projected expenditure, whichever is greater. If you were an emoney institution, it's 350,000 euros, and somewhere in between, between those two, generally, depending on the type of business that you have. And that's if you're, that wouldn't be for the more complex institutions. It could go higher again if you were a bank or you were a very large fund management company or whatever. And that's capital that gets put into an account and left there. You can't touch it. You can never spend it. You can't use it for day-to-day expenses. It is there in case bad things happen to the firm effectively, and you go into some sort of a wind down mode, or you have cash flow and you're, but it's very much as a fallback when things are bad. It's not there for running the business on a day-to-day basis, and that can be a big chunky amount of cash to just sit on and set aside.
It's pure rainy day fund, isn't it? Really, I mean, like you said, it's perhaps even harder to swallow where you're being told you can put that in, but you can't touch it.
If you wanted to touch it, you'd have to. And this is the other thing we'll talk in a second about the mindset of a regulated firm. But if you wanted to touch it, you'd have to go to the regulator in advance and get pre-approval from the central bank. And of course, as soon as you go to the central bank saying, I need to tap into my minimum capital, the flags are going, right? The sirens are going off.
Yeah.
Why? What's going on? What's wrong with the business? And that could well be a sign that the business is in terminal decline and on the way out.
Yeah.
So it sits there, and if it's needed, then it's not a good sign.
Yeah, exactly that, and that's not going to look good on anyone. I guess the other thing that always comes up, not always, but on a lot of occasions, is, look, I want to get regulated in Ireland. I already have XYZ approvals in the UK or Estonia or Malta, and I'm then coming to you going, Danny, they've got this already. How does this actually help them with the move to Ireland?
Well, it does and it doesn't. There's a couple of ways it can help, right? So we've talked about the expenses and the costs and effectively the high barriers to entry. So it is not easy, and by the way, it's not meant to be easy. To get an authorization from the central bank, because from their perspective, they never guarantee any firm, but they are putting their reputation on the line every time they sign an authorization letter for a new organization, because they know if that organization fails and investors and men on the street or ladies on the street lose out as a result, that they're going to get it in the neck, and maybe rightly so, and people will be on the radio and to Joe Duffy complaining about what was the central bank doing. So they have to be very careful about who they authorize, and so the barriers to entry are very high. But once you get over that barrier, mostly you will have a passport for Europe. So that means that if you set up your Irish MiFID firm or your Irish emoney institution, you can then establish a presence in other member states without having to go through the full rigmarole of an authorization process each time. It's much more straightforward. So it does give you great access to the entirety of the EU, and that's the carrot to balance off against the stick of having to go through an authorization process. If you've been authorized in another jurisdiction, well, if it's another EU member state, you might have the opportunity to passport into Ireland. But even if you don't, the fact that you've successfully navigated an authorization process somewhere will immediately demonstrate to the regulator that you probably know something about running a regulated business because you've been authorized elsewhere. And so that you're more likely to be on the right track and have the right mindset and even have the paperwork, the kind of policies and procedures that you're going to need to get through an authorization process and to run the business the other side. So it is a good pointer that will help you to demonstrate to the regulator that you are individuals in an organization that know what you're doing and aren't going to fail investors. And you'll have, as an organization, you should have the experience and you'll have some of the groundwork probably covered. There'll be duplication, hopefully, between your other authorization process and what you're going to do in Ireland. So it should make it a bit easier. But there isn't any, it doesn't mean that you get an easier time, if you like, or you get to say, well, here's my Estonian license. And the regulator looks at it and says, oh, that's fine. Here's an Irish license. It doesn't work like that at all, but it will help. The other thing that, sometimes people, I think, maybe slightly misperceive is that I can buy a license or I can buy a firm and take their license. It doesn't work that way either. So if you would, for example, buy an Irish authorized MiFID firm or an Irish authorized fund management company, you have to go through a process with the regulator before the acquisition is completed, an acquiring transactions notification, where effectively they put you through the ringer anyway and test and see, are you fit and proper? What's your intentions for this business that you're going to buy? How are you going to finance the transaction? How's the business going to work into the future? What are your projections and all that? So you don't get to just, you should never proceed that you can buy a license and plug and play. You don't. The regulator will still want to know who it is that's acquiring the business that has the license, and you got to go through that whole process. In addition to, and close to your heart, Andrew, in addition to the actual acquisition of the business and all of the due diligence and share purchase agreements and all that side of the business.
Yeah, of course.
Of a transaction, the normal transaction from a legal side plus an acquiring transactions bit. So you don't get to just buy a license and off you go.
It's a constant. I guess it's a constant challenge, both for someone like myself that works with companies in and around disruptive tech, and for the entrepreneurial type people themselves, and that there's a recognition of needing these processes, but it's a very fine balance between what's perceived by some to be stifling innovation and by others a necessity. But I think I think the regulators across many EU jurisdictions, not just Ireland, I guess, had their fingers and toes and everything else burnt only 10-ish years ago. And I guess that can't happen twice in a lifetime, can it?
No, and they're very much on alert for what are the the innovations and the developments that affect financial services, and do we need to worry about them enough that we would bring them into an authorization regime. So, for example, when loan origination a few years ago was kind of being closely monitored because there was an interest in whether that would get enough traction that it would start to become maybe systemically important or sufficiently important that it's worth dedicating the regulatory time and the legislator time to set about designing rules just for loan origination or just for crowdfunding or just for crypto asset firms and what have you. And of course, for a lot of them, the threshold has been reached, and now we're going in. They're sufficiently big and important, and enough people use them that it's worth putting in place regulatory regimes around them. But it absolutely does stifle innovation, because you don't get to just wake up in the morning with a great new idea for whatever your development is, working it through the night, and the following day you hit the market with it. Once you are a regulated firm, and I think maybe we wrap up on this point, certainly from my side, in terms of the mindset of a regulated firm versus particularly, disruptors and disruptive tech, where they're so innovative and creative and they have new ideas to challenge the norms and do things differently. And that's their founding ethos, the reason for being. But once you become a regulated firm, you really have to change your mindset, because you now have a regulator who sits on your shoulder and questions everything that you do, and that you should expect that you will need permission from your regulator before you can blow your nose. Yeah. Because you want to take out capital. No, well, you got to get permission from the regulator. You want to engage in a new activity. Well, you got to get permission from the regulator. You have to be very careful about being and keeping in compliance with all of these rules that you've signed up to. And that can mean that you don't get to wake up in the morning with a brilliant new idea and take it to market that afternoon. You've got to go through a process again with your regulator, or at least maybe with your compliance team and your lawyers. And so that slows everything down and adds costs. And that is the flip side of, I guess, the innovators and the disruptors having gotten to a size where they're sufficiently important at getting enough traction that they get these regulatory regimes designed for them.
Yeah, and actually, just on that point, the way that I have tried to almost not so much downplay it, but to make it more relatable as a process is, look, okay, you're now a big, as if talking to Mr. Crypto Exchange, you're now a big exchange. You've gone through 3 rounds of venture capital investment. Going back to the first round of venture capital investment you went from not having to answer to anyone to having 5 pages and a 100-long list of reserve matters of things that you cannot do without investor consent, for all manner of things, legal and commercial. You have 20 pages of covenants, things that you will do. You have another 20 pages of negative covenants, things that you promise you will not do. And almost the fully fledged regulatory process with a financial regulator is just the next step up from that. So these things probably come as a shock initially. And like you said, behaving like a regulated business, it's the same way that we're saying to people, now you're not just on your own, you now have to behave like a business that has venture capital money, other people's money, lots of it. And you're ultimately responsible for it. So I guess it's just the next stage in the life cycle of businesses that want to go down that road.
It's kind of like the price of growth, isn't it? It's
exactly.
You're now responsible for other people's money, whether it's in that venture capital money coming into your business, or particularly if you're a financial services firm, you are minding, responsible for money that is not yours. You have an opportunity to profit at the expense of the people who trust you to look after them and to do well by them. And this is my last thought on it, right? The key difference between being a regulated firm and being an unregulated firm, a tech disruptor, is that once you are a regulated firm, your primary obligation now is not to yourself and to your bottom line and to your bonus at the end of the year or to your equity investors. It is to your clients. It is to the people whose money you're managing or safeguarding or minding or whatever. Your primary obligations are to them and to do right by them, even if that means doing something that costs you. You have to do right by your investors. And that's quite a different mindset than what firms would have had before. And in addition to all of the the constraints that being regulated puts on your ability to innovate and act quickly and be agile. So if that 25 minutes doesn't put you off going down the route of being a regulated firm, welcome to the gang.
Yeah, indeed. Yeah, we like scaring people off, don't we, Danny?
Well, this is listen to the podcast. If you got to this long in the podcast and you're still listening, then there's hope for you. But a lot of people will have the line will have gone quiet long before this, because it is expensive. It is a big undertaking to go down the route of being authorized and regulated. And to be frank, unless you're going to do it right, you're better off not doing it, because somebody's going to get hurt. So you're better off not going down that route unless you can do it and do it well. But if you can, then you get to access a whole other universe and size of investor universe and client universe that you don't otherwise have, because you maybe have to operate on a private placement basis or whatever it is. But you have to be careful. You have to do it right.
Indeed, that is the overarching message.
I think so. But having said that, we touched a little bit on crypto advisors, and there is a draft regulation for the markets and crypto advisors regulation, which is kind of a MiFID for crypto advisors. And we're going to spend a little bit of time on that in the next podcast, Andrew, to kind of give some pictures on the types of things that are in there, but also maybe how firms might that are in that space now or about to go into that space, how they might think about that regulation and organize themselves today to be ready for it in somewhere between 2 and 3 years' time. Yeah, and hopefully the certainty that will bring while there will still be plenty of hurdles. The one thing we haven't had in the crypto sector, certainly in the European Union, is certainty around regulation. So yeah, that'll certainly be interesting to have a chat about. I know. I certainly in my career as a regulator, I'd often hear from people how they really wanted was certainty. You heard a lot in the Brexit discussions as well. We want certainty, and then of course when you give them certainty, but the barriers are very high. It's like, oh, Jesus. Not that much certainty. No. We didn't want. We wanted a little bit of certainty. That was well, what about the flexibility? What about the flexibility? You're stifling innovation now. How dare you? Yes. Well, let us pick that up in the next podcast. Andrew, thank you very much for your time. Thank you very much, Danny, as always. I think that's a pretty good summary of the kinds of conversations we've had with people over the last couple of years who they're interested in getting into this space, and then we managed to scare them off. Indeed, we have. Good. Well, listen, thank you for your time, Andrew, and I'll catch you next time. Thank you, Danny. Cheers. Thank you.
Thank you for listening today. We would like you to be involved in our next initiative. Visit fundsirelandminicon.com/get involved.